Hello and welcome back to They Don't Teach This in Law School. I'm your host, Charlie Mann of law firm Alchemy. And today we are digging into the finance side of your law firm, a topic that we don't get to quite as often as, say, operations, marketing, or leadership on the podcast. So I'm really excited to have someone on here who actually works with law firm owners like you, the listener, to help them achieve higher levels of profit in their practice and master the financial side, which may not be nearly as fun until you realize it's the money in your pocket. And that sounds like fun to me. So I'm excited to have on our show the founder and owner of Net Profit CFO, Ryan Kimler. Ryan, welcome to the show, man.
Thank you very much, Charlie. Thank you for having me. I appreciate the opportunity, and I'm excited to talk to your listeners today.
Awesome. All right, let's kick it off with the question. What's the one thing they don't teach you in law school?
So my answer to that, hands down, is it's about the finances and how cash flow works, for sure.
Cash flow is such a complicated topic in law firms. And I know we're going to probably transition across a couple of practice areas, but I'm curious, in the context of a law firm trying to solve for cash flow, what are the core issues that you see with cash flow? And I mean that with like a big umbrella term. Take it where you will. What are the issues we see with cash flow?
Sure. So I think for starters, I mean, we've got to understand where cash flow comes from and how we get down to net cash flow, right? I mean,
well, as my parents told me, money doesn't grow on trees, so it must come from somewhere.
That is true, right? And so if you're a listener out there, right, and you went and you looked at your bank statement, let's just say from the beginning of the year, right, January 1 and whatever your balance was, and we're getting ready to close out May here. Let's say you looked at May 31st. There's going to be a difference there in what your cash is, right? Maybe you had $50K in the bank in the operating account, and now you've got 75, right? And so you had $25,000 of positive cash flow. But how do you get there, right? And so it starts with the net operating profit of your business, right? That's where the main source should be of dollars being pumped into your business, should be from the operating profits. But then after that, there are adjustments that take place. And that's where it gets really, really tough sometimes for lawyers to kind of figure out and law firms to kind of figure out, like, okay, what were the adjustments we have to account for, right? And so some of those adjustments, just real quick, just so that we're all on the same page and kind of talking the same language. Number one would be clients that have not paid you. We call that accounts receivable, right? Number two would be if you took on any additional debt, right? So we're kind of a couple of years removed from the pandemic area, but if you had like PPP loans or idle money or anything like that, right? I mean, that's cash that's pumped into your business that did not come from operations. And so that's one of the things we have to account for as well. If there are bills that you have not paid, we call those accounts payables, right? So an example would be if you have a credit card with an outstanding balance, all right? And that kind of falls under debt as well, but that would be an adjustment to cash as well, because while that credit card has a balance, let's just say it's a $5,000 balance, that's $5,000 of cash that you did not take out of your bank account to pay those bills, right?
Right.
And then lastly, we get down to the owner section and kind of equity. And we've got to account for owners' distributions or draws, or if you put money in, if you had to make a contribution, that would be an adjustment as well. So those are kind of some of the high level main things that we adjust for. One other thing that's really less common would be if you bought assets. Assets, when I say an asset, that's like a big purchase, right? And so really the only example I can think of for a law firm with that would be if you move to a new office space and let's say you bought a bunch of furniture. Right. And let's say that furniture purchase, just for easy round numbers, is $30,000. Well, the IRS basically says, hey, we don't want you expensing that full thing this first year because then you'll pay us less in taxes and we want our money and we want it now. And so they make you put that on the books as an asset and they make you space that expense out over several years. Okay. And so if you went out and bought that asset, it's not a direct impact to operations, which means that is not in your net profit number. And that would be an additional source of where some cash probably went to that is not going to show up in your operation. So we've got to adjust for a lot of things.
Oh, goody. That's always what an attorney wants to hear is I have to adjust for a lot of things when I'm still trying to figure out the difference between gross and net, which I'll tell you, Ryan. So this is the way that I started to figure out gross versus net was with a fish analogy. I said that fish are gross. The question is, how many do you have in the net? So that was the way that I started learning about gross
Very
and net.
nice. Very nice.
Yeah, right. It's a real idiot's way to understanding finance. So the cash flow problem in a law firm, one of the greatest issues is the when we're signing a client and when money actually comes in.
Yep.
When you're dealing with firms, how do you help them? And this is about to be a bookkeeping term, reconcile, but I love the term reconcile. How do you help an owner, maybe from an understanding the finance, reconcile the deferment sometimes between when work is done and when money is coming in and how that all gets handled?
Yep. So I think the easiest thing to do is probably just to walk through like an actual case, right? And so a lot of times I work with a lot of hourly bill and flat rate fee attorneys. And so let's just take an hourly bill case. Let's take a family law lawyer that is doing divorces, right? And they're billing by the hour. I always guide them that whatever you think your monthly billings are going to be, you need to collect a retainer that's 3 times the monthly billings. Oh. And then let's walk through the timeline of that and let's walk through the accounting of that. Okay. So let's just say for easy timelines, you signed up a brand new divorce May 1st, this year, 2024. Okay. So you're going to work on the case all of May. Okay. And let's assume you're doing your billing on a monthly basis. All right. So if you're really, really, really efficient, okay, your bill goes out June the 1st, 2024, which most law firms are not, right? So, but we'll give you the benefit of the doubt. So you've worked all of May, the bill goes out June the 1st. Most firms have 30-day terms, which means that bill is due July the 1st, right? 30-day terms forward, okay? So meanwhile, right? So you've worked all of May, you've worked all of June, and the bill is due July 1st. Now, we all know that for whatever reason, people do not like to pay their lawyer, okay? And I always say that your clients, they treat your bill kind of like the mortgage rule. It's due by the 1st, but it's not late until it's past the 15th.
And I don't know what you're talking about.
And so what ends up happening is, again, you've signed this client up May 1st. You've worked the whole month of May. You issued a bill June 1st. You've worked the whole month of June. And it's due July 1st, but you don't really know if you have a deadbeat client until it's about July 15th or July 20th, okay? So at this point, we're 2.5 months into the engagement, right? And so for you to really be protected, that's why I say 3 months of a retainer. Now, again, that's also you billing on the first day of the month.
Right.
So let's backtrack and let's talk about the accounting of that. So there are 2 different types of accounting, and this makes things even more confusing. There's accrual,
here we go.
There's accrual and there's cash, okay? Cash is very, very simple. It's very, very straightforward. It's like it sounds. When you collect cash, it's booked as revenue, okay? And most of the firms out there, you're probably on a cash basis when it comes to your taxes, okay? So when you collect money, that's when it's recognized as revenue. So in this case, let's say your client paid you for your June bill on July 15th, okay? If that was the case, you would recognize that revenue on July 15th, okay? Now, on an accrual basis, accrual accounting says we recognize revenue and expenses on the date that they're issued, okay? So in other words, if you issued this bill June the 1st, that revenue gets recognized in June. And so you can see just from this one case timeline, right? One method of accounting, we're recognizing the revenue in June. One method of accounting, we're recognizing it in July. And so it can make a really big difference, all right, as far as when revenue gets recognized and what your firm's statements might look like depending on what type of accounting you're using and what type of accounting you're looking at.
It can feel like a real 3-card Monty setup of like, which one's the queen? Can you see where the queen's going? Have you seen where the queen's going? Oh, no, it's not over here. Turns out it was over there. I find that to be extraordinarily frustrating for a lot of firm owners as they start to not even start to master it. They try and hit that initial breakthrough moment with it, right? Where they transition from the classic, how much money is in the bank, right? That's their basic finance. Do I have money in the bank? Is my Alta taken care of? Great. We're good. We don't have any major issues. They're in their QuickBooks a few times a week, some of them every day, and they're just trying to self-reconcile everything. 2, okay, this finance thing, there's got to be something to this, right? There's got to be a reason that we have this. So I'm curious, for the firm owners who are starting to realize that, because when I coach, Ryan, one of the things that we focus on is the triangle of marketing to operations to finance, right? Those are the 3 major entities within the firm, with marketing and operations being the much beloved children, and finance being the stray dog that keeps showing up at the doorstep, essentially.
Sure.
So when someone decides to embrace finance and go, I want to right size my firm in terms of its financial metrics and my personal understanding of it, what's some of the earliest work to be done there? And what are some of the biggest issues you usually see up front?
Yeah, so I think some of the earliest work that law firm owners should really do for the long-term game is find the right financial professionals and get them in your court as soon as possible.
Okay.
And find experts to work with. I mean, the bottom line is we all can't be experts in everything, and accounting is one of those things. Accounting in your finances is one of those things that you just need the expertise. You need the help. And so, I always like to talk to this, and there's really, if you're a growing law firm and you're approaching, let's just say $750,000 or $1 million and beyond, you really are going to need 4 big financial professionals that are going to help you in your journey and continuing to grow. And the sooner you can get these people in your life, the better off you're going to be. And so those 4 positions, number 1, you should have a great bookkeeper or bookkeeping team that's keeping track of all your finances, doing everything in QuickBooks. I think everybody kind of knows that. And that person you should actually bring in probably when you're around $100,000, $200,000, because typically, they can, especially if you're working with an outsourced firm, they can be affordable, and then you're not spending the hours doing that. It just makes sense.
Yeah.
Second thing is you need a good tax preparer that's going to keep you out of trouble with the IRS, keep you in compliance. Everybody has to file their taxes, right? It's guaranteed. Third thing is, as you start to grow, is a part-time CFO, just kind of like our firm does, right? Someone that's really there to educate you, guide you, help you make decisions, and as you kind of use the words, help you right-size your firm so that you're building a strong financial foundation in your business, and so that you're making the money that you want to make. Okay. That's really the 2 functions of a CFO and what they're going to do for you. And then the 4th thing is, and a lot of business owners miss this, is you need a good retirement advisor. I'm not going to say financial planner necessarily, because I think there are a lot of financial planners out there that just sell life insurance, and I'm not on board that that's the best retirement strategy. And so you need a good retirement advisor. And if you think that's the best strategy for you, then fine, run with it. But you need someone that is going to work with you and is going to help you invest in things that you understand. And is going to kind of be that educational component, just like a CFO is educating you in the business finances. A good retirement advisor should really educate you on what you're investing in and how that's going to play out for you and build a retirement plan for you. Gotcha. So those are the 4 positions that you need as a law firm owner. You really need in your life as soon as possible, right? Get that on track, start building those relationships, and find someone that you really feel you can trust. And that's all where it starts for kind of right sizing your firm for profit and for cash flow. Is just getting the right professionals in your wheelhouse and continuing to learn.
So you used a phrase in there, help you make decisions, when you were talking about the CFO side, which the whole fractional CFO thing, it's not entirely new, but it is rapidly growing, and it is coming to the top of mind more and more often for firm owners. But that idea of helping the firm owner make decisions. If I'm a firm owner, I might be thinking to myself, If there's money in the bank, I'm going to buy the thing. If there's not money in the bank, I'm not going to buy the thing. And that's worked out just fine for me for a while. Why am I spending money on an expert in order to tell me when there's money in the bank and when there's money not in the bank? So what does that idea of help you make decisions really mean?
Sure, sure. So I'll tell you one of the big ones, especially as you grow, is that you're not going to find the answer on whether or not there's money in the bank is what about hiring and setting up structures for attorneys
Yep.
and bonus structures and things like that. Um, I have come across some attorneys that have gotten themselves in some really bad situations because an attorney that they're going to hire, just comes in the door and, they start asking about bonus structures and the firm didn't really have one in the past. And the attorney
Mm-hmm.
goes, well, here's one that I had at my last place. Right. And so they
Oh,
just start kind of running with that and it can get the firm in some real financial trouble. And so that's just one of the examples, of a decision that, you really need some guidance in, really need some help with, that you're not going to find of, oh, do we have money in the bank or not?
right, right. Yeah. So, and like, that's one of the first things that anyone who talks with a firm owner on a business level should try and disabuse them of, is that idea of money in the bank means that there's money in the bank, which is a
Yep.
weird concept. And you and I could probably go even deeper on, say, the accrual level of things, especially if we're talking estate planning firms and you've had fees that have been paid, but the plans have not been executed. And yeah, there's some pretty in-depth stuff that goes on here, which is why having financial professionals helps. But when you're a firm owner thinking about these hiring plans, all of that, what are some of those conversations that people have and maybe should have with their financial professionals look and sound like?
Yeah, absolutely. So I think one of the biggest things there is you need a regular meeting structure,
Okay.
right? And really, I mean, your part-time CFO should bring that to the table and say, hey, this is what it looks like, right? And if you're a growing business going towards $1 million or beyond $1 million, you really need a monthly meeting to review the finances, review the decisions that you're going to have to make, and they're coming up in the near future. And that monthly meeting should really cover, like I mentioned, any of the upcoming decisions that you have, but also your CFO should bring issues to the table as well and things that they're seeing, things that they're concerned about, so that you as an owner can be aware of them if you haven't seen them already.
Mm-hmm.
And if you're just looking at the bank balance, you probably haven't necessarily. And that way you can make adjustments and you can make changes to the firm. And
Yeah.
so I think that's probably the most important thing is you've got to have a regular meeting and, just bringing all the issues to the table and covering the finances, asking any and all questions that you have. And that could even be, down to, are we even priced right on this
Mm.
thing? Right. Especially, I know some flat rate attorneys can get into traps of, pricing something flat rate. And then, you kind of go and you look at the hours of it and you figure out, oh shoot, we've been working for $125 an hour. Like I've seen those kind of things, right?
Right.
And so it's really just bringing all the issues to the table and getting a conversation going about it and getting things, kind of moving towards being solved.
Yeah. So, and that actually brings up the idea of estimates. So when you have this, say someone is billing, I don't know, $6,500 for a particular package of wills and trusts, right? And they're doing this breakdown of time that goes into it. And at some point or another, we're getting into a space of estimation, right? Because we're talking about a firm where the data sets are limited and how refined the tracking is limited as well. Because truly, until you're close to say $7 or $8 million per year in revenue, and you really have the volume levels to accommodate mass data analysis, you're playing with a greater margin of error. Now, for budgeting purposes, for forecasting purposes, this is where I find, Ryan, a lot of firm owners collide with the idea of estimating and optimism and cynicism about their finances. So within that chaotic amalgamation of factors, what is your tolerance for that level of estimation, for the optimism on forecasting. I know I've kind of tossed a lot into this sudden salad or soup of ideas. So
Yep.
help me out here, and let's sort through it a little bit. I'm coming to you as financial professional.
Sure.
How are you guiding me?
Yep. So my biggest thing is I always go back to the numbers, and I like to break things down. I always look at those types of questions and I always ask myself and ask the owner two questions. Number one, is it profitable for your firm? And a little bit of a background on that, right, is, I expect that all the firms that I'm working with, we're getting you to a net profit. That means all the bills are paid and everything with operations is done. This is money out of operations to go towards cash flow. Minimum percentage is 20 to 25%.
Okay.
And that includes the owner being on payroll at a reasonable salary.
Okay. So that percentage is separate from the owner's payroll.
Correct.
Okay. I'm just clarifying for the audience. I understood what you meant. Just want to make sure everyone hears that what you're talking about is owners being paid the reasonable salary. Now we're getting to that S Corp territory, no doubt.
Yes.
And now that 20 to 25% is, you could be bringing that much home in addition.
Yep. Yeah, and you brought up a good point there on S Corp reasonable salaries. So when I say reasonable, I'm actually not talking about from a tax perspective. I'm talking about just from a, if you've got $1 million business and you're the owner, you getting a $400,000 salary out of $1 million is not reasonable. Okay. At the same time, we are not trying to avoid paying self-employment taxes, and we are not writing down your salary as low as possible to say, okay, well, you only lawyer half the time and the other time you're doing marketing and administrative work, so we can lower your salary to 60 grand. That is not what I'm talking about either. I'm talking about, reasonable compensation. If you were an employee of the firm and you were an attorney, I mean, you're probably not going to quite get there, because if you're the owner, you probably have a little more expertise, right? And realistically, you would probably be in the mid 200s, but you're in the mid 100s.
Moshe Amsel would say it's your replacement cost.
Yeah. Or as close to it as we can get. Yes. Yeah. So that is what I mean by reasonable salary. Yes.
Yeah. Good to know.
So again, that kind of answers question number one is it profitable? Number two is it scalable? And so when we get down to the, is it scalable? So again, let's go back to the example you were talking about, $6,500 for an estate plan package, whatever. Biggest question that I'm going to ask is, on average, how many hours is it taking you to perform the work that goes into that $6,500 package? Okay. Right. Now, as the owner, obviously the hours that it takes you is probably going to be a little bit less than what it takes your staff. And so we are going to adjust for that. But I always bring it back to kind of, the gold standard in the marketplace, it seems to me, is associate attorneys, minimum billings per year is like 1,500 hours. That's kind of the gold standard, right? I mean, there are some firms that have higher requirements than that. I've seen all the way up to 1,800 hours a year. Yeah. In my opinion, you get up that high, they're really playing a churn and burn game. Yes. They're big firms that, the attorneys want that big firm experience on their resume. And so they go and they do it for a couple of years, but that's not something that's really sustainable. Okay. Yeah. So what I always bring it back to, again, is 1,500 hours per year. And once we get down to how many hours does it take for you to deliver the $6,500 package, then we figure out what is the top revenue that you could really produce if that's all you were doing. And so that way we have, if that's your top revenue, and we know that at your firm you need probably a 4x return on associate attorneys is probably the minimum, then we can divide by 4 and we can say, okay, can you hire somebody all in, all done, including taxes, benefits, 401k, healthcare? Can you hire somebody for that price? Right. And if the answer is no, then one of the factors has to change, right? Either number one, you've got to figure out a way to get it more efficient so it's less hours, or number two, the price has to change, right? And so kind of by looking at the components and breaking it down and kind of reverse engineering a little bit, we can figure out if that's really doable or not.
Mm-hmm. So that, I mean, doing that math, over time, let's say $6,500, you're spending 20 hours between full team hours on this thing. So we're looking at $325 an hour, right? For those who are doing back of the napkin math, that
Sure.
chances are is you should be making a margin on that, right? So you know that. But the issue starts to come in some of the inefficiencies. Now, here's the thing. Most people see these inefficiencies, in my experience, Ryan, they see them from an operations perspective first. So it's a finding inefficiencies that way, which means they have to go into timelines, figure all that. How can finance play a role in identifying some of those inefficiencies faster?
Yeah. So you're gonna figure it out in your profitability first. If you're really looking at it, you're really tracking it. And so one of the things I mentioned earlier was, my expectation, when I'm working with firms and what I kind of work them towards is a 20 to 25% net income margin. So that's after all your bills are paid. And kind of my rule of thumb for that is typically we want payroll to be between 40 and 45% of revenue. Marketing is typically between 10 and 15. And your overhead is somewhere between 20 and 25. Now that is a number that, post pandemic, a lot of times we can get under that because firms are not having as much office space, things like that. But when you can make I gave ranges there on all three of those numbers, but you can typically make a combination of those three numbers and get down to the 20 to 25%. And so if you're kind of looking at your income statement every single month and you break out those three buckets and you divide by the amount of revenue that you're really bringing in on a monthly basis, that's where you can first see like, oh, my payroll is 54% of my revenue, right? And so like right there, like once you're over and above and beyond one of those metrics, like why is my payroll that high? Just to put that in perspective, if you are looking 54, 55% payroll cost, that means you're getting less than a 2x return on all of your staff. Right. And so those are the kind of things that you can look at really, really quickly. And when you know what to look for and you kind of know the metrics and you have someone coming alongside of you and helping you, learn those things and set those targets, you find it very, very quickly. It doesn't take long at all.
So profit could be a canary in the coal mine of sorts.
For sure.
Now, if someone is right now thinking, "Oh, I need to go check on that. I need to go check on my numbers." Is there a particular like time range that you might suggest someone look at?
Yeah, so I would probably recommend, look at the last 12 months if you can get a rolling 12 months. It also depends on what's happened at your firm too, right? If you've had staff turnover, if you've hired new staff, because there are going to be, there are going to be periods of time where you probably are going to be over that 45% payroll mark, especially as you hire new employees, they're not efficient. So it really depends on what's happened at your firm. Those kind of metrics that I've given, that's really for a business that's working towards efficiency.
Gotcha.
Not necessarily for aggressive growth, right? If you're doing aggressive growth, you're not going to have 20, 25% net income margins, right? It takes money to grow, and so I think, again, like working with a professional and kind of planning those stages out on, yes, if you want to grow, yes, you can have some periods of time where you are aggressively growing and making less money, but then you also need to have some times where you slow down and do make some good income. Because especially as you grow and your expenses get larger, you probably want more of a cushion in the bank, which means you probably need to slow down and build up some reserves. And so like I said, I think the last 12 months is probably a good place to start, but I would say it also depends on what's happened at your firm.
That's fair. So if someone's interested in learning more about you, about how to work with you, or just connecting with you in general, where should they go?
Yep. So easiest place is probably just netprofitcfo.com. At the very top upper right-hand corner, there's access to my calendar. So if you want to book, complimentary 30-minute meeting with me. I'm happy to talk through, anything that they're interested in, anything that I can help you with. That's probably one of the easiest places. Second place is just type in Ryan Kimler into Google. That's Kimler. LinkedIn always does a great job of, bringing profiles pretty well to the top. You're gonna find me. There's not very many Ryan Kimlers out there, and so that would be a second best place. But usually, just netprofitcfo.com is the easiest for sure.
Awesome. So Ryan,
And
one last little question for you, but it's a 3-parter. That is, what are you reading, watching, and listening to these days?
Ooh, okay. So reading right now, I am in Business Made Simple by Donald Miller.
Oh, great.
So that's what I'm reading. Watching right now, actually, I'm watching Breaking Bad right now. Really,
There we go.
I know that's an old one. But I haven't watched it. And then also Yellowstone. I'm going back and kind of catching up because there's a series of Yellowstones coming out later this year in November.
A lot of them.
Yes. So I've been watching those, and they just had the Memorial Day marathon too. So I was kind of watching and getting some caught up. And then on the listening side, I'm listening to a couple different business podcasts. One of them is I always follow the Story Brand podcast that Donald Miller has. And then I also follow Becoming CEO is another good one where they just talk operations management, things like that. So that's what I'm listening to.
Awesome. Ryan, I genuinely appreciate the discussion that we had today. Felt, even though I know that there are some people who may need to slow down the speed on it just a little bit or go back and rewind and re-listen to some things because it is financial terms. And even when we're breaking it down into what felt like fairly pragmatic and jargon reduced a framework, I know it can still feel jargony for folks, but I really do think we've hit some key elements that are very accessible that advance the conversation. I appreciate your ability to make it accessible in that way. So thank you for all your insight and wisdom through this show.
Of course, I really appreciate that, and I always try my best to do that. When I'm talking with law firm owners, I try to talk as a business owner, not as an accountant, because as you mentioned, I mean, there is a ton of industry jargon out there, and it does just make things more confusing.
Yep. And
getting with the right professional, they should be able to break things down like that for you, right? Because the finances is hard, right? I mean, it's that is not. I mean, it's really not an easy piece of business, and I fully recognize that, and I appreciate your compliments there, and that's always top of mind for me, and I try to be mindful of that and talk like a business owner and not like an accountant. So
good call. Ryan, thank you so much for your time and knowledge today.
Absolutely. Thank you for having me on the show. I appreciate it. And yes, thank you very much. Looking forward to the show coming out.
Me too. And we will see you all in the next episode of They Don't Teach Us in Law School.